golly, this is crazy. So you can do a call debit spread on Amazon for $600 versus paying $3,000. Hey, what's up YouTube? This is Foxtail Digital coming to you again with Black Girl Stocks. And in this video, we're going to be talking about debit spreads. So this is a cheaper way to go about trading options that a lot of you guys have been asking about. When you're buying debit spreads, you're basically getting cash discounts for options like 15%, 20%, 50%, and up. Sometimes it could be more than that versus if you were to just buy a regular call or put. Now, what really inspired me to make this video is one of you guys left a comment on one of the top 3 option plays videos, but you asked me, how would you expect beginners to be trading options on expensive stocks like Apple, Tesla, or Amazon? So this video is definitely going to be helpful if one, you want to try out, more advanced option strategies outside of just buying and selling calls and puts, or if you just want to trade bigger stock options for cheaper. I talked about doing debit spreads very little in a few of our top 3 option play videos, and I'll just kind of give you different strategies that you can do, but we never really went into detail. When you're doing spreads, you're gonna buy one option and you're gonna sell another option on the same stock, same expiration date, just with different strike prices. So when you buy an option contract to open a call or put, then you're gonna be paying money to open that trade. And the money that you pay, that's the option premium. Now on the opposite, you can also sell options to open. So you can open a trade by selling first. So when you do that, you're going to be the person that's actually receiving that premium instead of paying it because you sold something. So with debit spreads, you're going to be buying an option that's at a lower strike price. Normally, the lower the strike, well, it depends on if you're looking at calls or puts, but normally the lower the strike price is going to be more expensive. And then you're going to be selling an option that has a higher strike price, and the higher the strike price or the more out of the money, it's going to be cheaper. So there's going to be an amount that you're going to pay for the one option that you bought, and then there's going to be a credit that you receive from the option that you sold. The total amount that you pay is going to be a lot cheaper than if you were just to open that long call. This is why debit spreads are pretty much just an advanced way to buy options for cheaper. So let's look at one example. So let's say that we're bullish on Apple, and right now it's trading at 126. So we think that it's going to go up before expiration, and we have a list of strike prices right here. So let's say we pick the 125 in the money call for $3.40. So that's our premium. Above that, we're going to sell the 130 out of the money call, but that's only going to be for 90 cents. The net cost is going to be $250. So $250 per spread. That's 30% less than if you were to just buy that 125 call option. So that's all I'm saying. It's $125 less than that. Okay, but what's the maximum profit? What's the most profit you can make? All right, so let's say that the stock jumps up to 140 by the end of the week. And so with that profit, debit spreads are a gift and a curse because they cap your losses, but they also cap your gains. So with debit spreads, the most that you can profit is going to be the difference between the strike prices minus the debit that you paid. So in this case, it's going to be a 125 and a 130 call spread, same expiration month. So you're going to take that $5 and subtract it from the $250 that we paid. So the most profit that we can get is going to be $250 with this. So that's 100% potential in profit. That's 100% profit. That's not bad. But yeah, so in addition to saving $90 per contract by doing that spread, instead of just buying the call, you can make a full return on the investment. Now, debit spreads are very direction based. And when I say that, I mean they gain value when your direction prediction and timing are right. Predicting or projecting that the stock is going to increase in price and you did a bullish spread, you would be more profitable. Obviously, it's just like just like buying a regular call or put, it's the same thing. So there are bullish spreads and there are bearish spreads. So just like calls and puts, the bull call spread is the option strategy that you're going to use if you're bullish on the stock and you think that it's going to go up. So what you're going to do is you're going to buy the in the money call option and then sell the out of the money call option that's cheaper. So just like buying calls and puts, the most that you can lose with a spread trade is going to be the premium that you pay. But you're also going to be capped off with profits, like we said. To break even on a bull call position, you just need the stock price to be trading above the long call option, or the option strike that you buy. You just need the stock to be trading above that by expiration. You wouldn't have lost anything. But of course, we're going to sell these before expiration. Do not hold these. So those are bullish debit spreads. Now for the bearish spreads, the bear put spread is the option strategy that you're going to use when you're bearish on a stock and you think it's going to go down. So a bear put debit spread is made up of a long put option with a short put option that's sold at a lower strike price. The debit that you're going to pay it's the same. The most that you're going to lose with this is the amount that you paid for it, and then the maximum profit is going to be the spread with minus the premium paid. So the stock just needs to be below the long put option, the one that you bought, by at least the cost to enter the position by expiration. All right, so just some information about debit spreads in general. Just like buying regular calls and puts, single leg options, in the money spreads are going to be more expensive than out of the money spreads. All right, so let's say if we wanted to get into it on Robinhood, go to trade options or click something a little bit further out. Now, if you want to do a spread, all you have to do is just click the select in the top right hand corner first. Boom. So let's say I want to do a put. Okay, I'm going to buy the 149. I would sell 146. So this is a put debit spread. Okay, and so we have a net cost of 126 versus 200. Actually, it would be like $300 if I just bought a regular put. But because we did a put debit spread, now we're only paying 126. Okay, so boom, 127, boom. So remember this, the closer the strike prices are to the actual stock price, then the higher the debit price is going to be, but then the probability is higher that the option is going to expire in the money. And then the further out that the option strike prices are from the stock price, then the less amount that you're going to pay, you're going to receive less, and it's more likely to expire out of the money. All right, so let's say you were going to pick this strike price to buy, and then you were just going to sell one that was just one away. So this one is going to be cheaper. It's going to cost you $200, but your maximum profit is going to be lower. But let's say we move this out a little bit. That's $900. So that's actually a lot more, but profit amount, the maximum profit is going to be increased also. Okay, and you can exit out of these trades by selling to close the long option and then buying to close the one that you sold. Yeah, so if you're using Robinhood or Webull, they're not going to let you sell them separately because they'll say this option is a part of, option spread. So they won't let you close them separately. It's just going to be the same as opening or closing a regular option. You just click that option and you select close. So sell to close. And then the last question is, how does implied volatility and time decay affect debit spreads? So again, just like buying regular calls and puts, time is going to be playing against you with debit spreads. Time is not your friend. So if you can time it to where the actual stock moves faster in your favor, then that's going to be better for you. You can go ahead and sell it, exit that position, take your profits and be done with it. And then you can monitor the time decay with the theta and the option Greeks, but we're not going to get into that at all in this video. And then as far as implied volatility goes, when implied volatility increases, then the ranking increases on the option premiums, and so that means the spread is going to be worth more. Debit spreads are going to increase with an increase in implied volatility. So you want to enter the spread with a low implied volatility and then exit it at a higher implied volatility. So really, debit spreads are very, very similar just to buying regular calls and puts. It's just that you have a little bit of protection, and you also are able to get into certain option plays a lot cheaper. There's always options with options. That's why we like to do options. And that's pretty much just why I wanted to bring this video to you. Just kind of open your ears, open your minds on possibly trading options on higher price stocks, but for cheaper by doing debit spreads. So I hope that this video was helpful for you guys. And then also, if you haven't seen the video that we did on credit spreads, make sure that you check this video out. I'll leave this below. So this is debit spreads. Now get introduced to credit spreads, where you're actually getting paid to open up these option contracts. So credit spreads are pretty fly. Credit spreads are nice. All right,